Africa, economic growth in South Africa accelerated at a solid but a slower than expected pace in the second quarter, that driven by manufacturing. But with this simmering labour unrest in key sectors now clouding future prospects, we've got Animal Bishop, who is group economist at Investec, here to unpack what we're going to see going forward. But we did see 3% growth quarter on quarter. So talk to us about the key drivers of the number for the second quarter, Animal.
Well, it was really a rebound from the first quarter, 0.9%. So if you actually have a look at what happened in the first quarter, you had a significant contraction in the manufacturing production because of the fire at AlaSaw-Mittal's Vanderbijl Park facility. In the second quarter, the facility came back online, so it started to produce again, and you actually saw that very significant output of just above 10% of manufacturing production. So really it's a statistical base effect. If you were to take that out, you'd actually get a growth rate of close to about 1%. So I think, really having a look at year-on-year growth is probably a better indicator of the strength of the economy. Taking out this distorting news in the quarter-on-quarter sees adjusted annualized figures. On a year-on-year basis, obviously the GDP growth came out around or slightly below 2%.
Yeah, I mean, as I said, the simmering labour unrest, and it certainly doesn't feel like it's simmering anymore. It feels like it's becoming more pronounced. You've got 72,000 who are meant to go on strike at petrol stations, car dealerships next week. They're included in the strikes we've seen across the board already. We know that there could be a strike in the mining sector. What do you do when you have these uncertainties as a forecaster, as an economist?
Well, I think your third quarter always is strike season, so you do expect to see a bit of a dip. I think on a year-on-year basis, again, that will translate through. Remember last year we had a very bad quarter with the strike actions we saw in the mining sector, and that leached over into the fourth quarter of the year. So I think we're probably going to see a similar effect this year as well. All in all, what I really think it means is that we won't get GDP growth faster than 2.3% for the year, and it could well come out closer to 2% if the strike action is more pronounced than a year ago.
So what are your thoughts on the Rand right now? Because the Rand has been seen as perhaps a positive to, say, the manufacturing exporters. And I know that you came out with a paper recently talking about Rand forecast and your base case scenario. We've got the Rand at 10 Rand 40 today. What are your thoughts on the outlook for year end?
Well, I think we are concerned about the currency because the likelihood of it running to 10.60 and then it's slightly weaker than that is quite real. We've got quite a high probability of that. I think the worry really with the currency in South Africa is, yes, it does boost exports and manufacturing, and obviously with the global economy starting to lift and recover and that becoming more pronounced in advanced economies, clearly we should start to see some improvement in our trade figures as a result of that. But obviously that depends very much on the manufacturing industry itself and the exporters. Are they going to let strike action erode that? And are we going to actually miss the lift in the global economy, or are we going to start seeing a simmering down of this very heightened, I think, tensions in the labour industry?
One of the aspects that is going to be affected if you have more people being fired as a result of companies under pressure, essentially, or losing their job, perhaps a better way to say it, is people's incomes overall and on average are going to come down. How do you see that picture playing out in South Africa, and where does it stand right now when it comes to incomes in South Africa?
I think it's very worrying because there's a very close correlation between real growth in disposable incomes and that of household consumption expenditure in real terms. I think that obviously does make perfect sense because South Africans have very low level of savings, if at all. So the worry really is that slowing real disposable income growth would obviously further subdue household consumption expenditure. That's 2/3 of GDP. Your GDP growth would moderate further. In South Africa, obviously we do have a situation where many people are unemployed, and greater job losses clearly would exacerbate the situation. What worries me is that you're seeing very poor commentary coming out from the retailers saying that the consumers are facing tough conditions, that they're getting worse, bad debts are increasing, impairments are increasing. So all in all, I think it paints a very weak growth story, and I think we're unlikely to see any upward shift in interest rates in South Africa this year.
So that of course takes me to that question on monetary policy right now. What are your thoughts on the inflation environment as it's going to pan out? Because that of course is something that is going to worry the SARB. They have highlighted that, and also attracting capital to South Africa, where we are seeing a flight from capital from emerging markets.
Well, if you look at CPI inflation, we've clearly breached the target recently, and that's due to the fact that petrol prices rose very substantially, 84 cents a litre, and electricity and water prices escalated as well. So if you take those out, we would still be well within the inflation target range. And I think that's really the point. It's administered prices that are running away in South Africa, not consumer demand. There's no reason for the Reserve Bank to move on monetary policy because of that. Inflation will be back within target in October. There's already a petrol price cut scheduled for September. So I think the point really is the Reserve Bank cannot influence what inflation did in July or August. and indeed even September. They look 6 to 24 months out, because only in the 6 to 24 month period can any change in interest rates impact inflation in South Africa. So that's really the outlook there. I think in terms of the currency and in terms of the fact that foreigners obviously did sell off our bonds very substantially in the month of June, 10.6 billion's worth. Since then, they've actually been back in the market and they've been purchasing bonds. So,
it's been quite erratic though.
It's been erratic, but I don't think an interest rate hike would be seen as positive, because remember, foreigners also equally hold a very large part of our equities. And obviously if they do hike interest rates, and it would be a very preemptive move and obviously a policy mistake, that would result in significant sell-off in purchases of equities. The bulk of purchases here, virtually all of them occurred in the first 2 quarters of this year. So now you see very little foreign purchase, and that of course significantly impacts the rand as well.
Thanks for joining us today. Appreciate it.